So is the head of internet research at Evercore ISI worried about any of these data points? Well, let's ask him. He is Mark Mahaney, and Mark, obviously, Bank of America is not your firm. We don't expect you to comment directly on somebody else's report. But you just heard my other thing about valuation per employee. Is there any part of the valuation spectrum for your companies that you cover that worries you at all?
Well, let's see. We've had a major re-rating. I mean, we're 3 years into a tech boom here, at least in the consumer internet stocks that I look at. We've had a really dramatic rally in these names. There were very interesting entry points, I thought, earlier this year on Uber, earlier this year on Google, and I'm sort of struggling to find those great entry points on names now. They're good compounders. I think Meta is a great compounder at 23, 24 times earnings. I think the valuation is very reasonable versus the market, but it's not dislocated in the way that I really like to hunt for stocks. Amazon may be the closest I have to a dislocated stock, despite today's outage. I think it's actually one of the it's underperformed year to date, which creates the opportunity if they can get AWS growth to accelerate. And I think they will. I don't think today's outage really impacts that. I hope it doesn't. I don't think it will.
I've dislocated my shoulder. I've never dislocated a stock. What does dislocated stock mean, Mark?
Well, it's what I hunt for. It's DHQs, dislocated high quality names. So stocks that trade off 20 to 30% or trade at a discount to their growth rate. You had that with Uber at the beginning of the year. You had that with Google when it was trading at 15 times earnings. If you have a high quality company that's generating earnings in line with or faster than the market, but trades at a discount to a market, that to me is dislocated. There's a little bit of art in there, but there's a lot of science behind what's dislocated. So stocks that are generally trading well off their highs or their recent highs, and there's just not that many of those in the internet space or broadly in tech right now.
Does the brief Amazon Web Services outage that you referenced that we've talked about, does that change anything?
I don't think we know yet. AWS has had large outages before in the last few years. A year ago, they had a 7-hour outage. I don't think this is going to be as long as that, but AWS is so key to so much of internet infrastructure that a lengthy outage like this, in a time when AWS is perceived to be losing share, and it is losing share to other names like Google Cloud and Azure, this certainly doesn't help. So in order to win that incremental client, they better recover fully and quickly. So at the margin, it makes it a little tougher. Stock's not impacted at all, at least. I mean, I shouldn't say that. It's up 1.3% right now. Maybe it would be up more, but for this. You heard our kind of fun exercise in the segment before. We talked about some of the rare earths, but we highlighted Apple and NVIDIA. We weren't picking on those companies. They're just some of the biggest in the world, and they're in the news, so we threw them out. Is $123 million in valuation per employee? I mean, obviously everybody needs a raise there, Mark, but does that trouble you at all? Sure, it does. What I've focused on, though, is first I focused on the fundamentals and look at what's happened to revenue per employee and to operating income per employee over the last couple of years. I referred to it as ROAI, return on AI spend. And if you look at the 4 major hyperscalers, Microsoft, Amazon, Google, and Meta, they've inflected up. Like their revenue per employee all of a sudden gapped up beginning in 23. And operating income per employee gapped up. Now, there's a lot of variables that go into that. And part is that these companies have just gotten much more aggressive about managing headcount. But there's no doubt in my mind that you've seen these companies deploy AI and it's materially improved the productivity of each of their employees. So I look at the fundamental trend first. And then when it comes to the market cap, I could do a lot of funny things. Look at the PE. And if I see a name like a Google and a Meta trading at a modest premium to the market for what I think are kind of enduring consumer utilities, I think valuation is very reasonable. So I'll stick with my guns on those. I look at the major tech names. I don't see the 50 to 100 PE multiples or higher that I saw way back in the dot-com bubble.